So where do we even begin today? After last week's unexpected freefall following major news out of the Federal Reserve, both in regards to interest rate cuts as well as guidance on inflation and even rate cuts to come in 2025. Just wow. There's quite a bit to actually break down today. And because we all know that we can't just stop investing, I do want to cover 6 dividend stocks that I think are worth your attention right now for the long term that either have a solid dividend yield or one heck of a dividend growth rate, or in some cases, both. But before I cover those dividend stocks, I do want to share some of what I think are arguably the most important news bites for all of you to be well aware of as we head into 2025. And it really does all come down to the latest out of the Federal Reserve. Whereas Jerome Powell recently just announced and delivered through on his interest rate cut, slicing interest rates by 0.25%. Then right after, immediately after sharing that news, and we got a lot of that excitement, he followed that up with some news that was rather soul-crushing for investors, which was that he's got a forecast showing that further interest rate cuts will be prolonged, and moreover, inflation might rise back up from 2.1% to 2.5%. So what happened? Well, we ultimately saw a deep dive into the red on Wednesday before finding some type of footing. But what does that really mean for all of us as investors? That's what really matters. Well, if you're young and investing for the long term, talking about decades, not a whole lot. But I would just prepare yourself for volatility so you don't freak out or get nervous. However, if you're in your elder years, I would really just ready yourself for another year like this past year, whereas reliability and deliverability should be your primary focus, because if interest rates don't continue to come down, yet inflation spikes back up, well, we are looking at consumers and businesses just once again being pressed by both sides, or on both sides rather, meaning sluggish bottom lines and lackluster earnings seasons. Now, today's dividend stock picks are actually a mix of opportunities catering to every type of investor out there. So with that, I want to go ahead and kick into gear here with Power Integrations, ticker symbol POWI, which develops, manufactures, and markets mixed signal integration circuits, or ICs as we call them for short, which ultimately help with addressing or adjusting power supply, all of which can be found in, say, TVs, LED lighting, and various other consumer industrial applications. So very much a necessity for us all, but regardless, going through it now, as we can see, it's down over 22% on the year. Yet clicking out to that 5-year chart, we are ultimately going to see greenery here as it's trading for $61, which is up over 27% over the last 5 years. Now scroll down with me where we're going to discover an income statement that does check out, as well as a balance sheet, which is more important with assets at $819 million to just $67 million in liabilities. However, we are here for the dividends, so let's jump into Simply Safe Dividends, and we're going to see a safety score at an 82, a solid dividend yield at 1.35%. And while the payout ratio is a bit high here, over 74%, red flag, we will see it's got a 15-year dividend streak thus far, a whopping 17% growth rate as well, at least on average, over the last 10-year period. Now, perhaps Power Integrations just isn't your type of gamble. Let's go ahead and put NextEra Energy on your list into the test, ticker symbol NEE, which for a long while has just been quite a prominent name within the energy sector as the world's largest electric utility company. Of course, that makes me love it purely for what it stands for, given the direction we're actually heading in, but more importantly, just its sheer size and dominance in the industry. And if we click into the stock chart, we're going to see that it remains in the green overall this year, but certainly slid recently, now trading for $70 per share. And if we click to that 5-year chart, we will see that it's just an energy powerhouse with well over 16.2% worth of appreciation over time there. Now scroll down and you're going to discover a stock with perfect green metrics, showing over 34% worth of revenue increases on top of 76% worth of net income growth. Jump to the balance sheet itself and you will notice a solid green ratio there, assets to liabilities, with assets topping $177 billion versus just $118 billion in liabilities. But more importantly, again, we're dividend investors, so tapping into Simply Safe Dividends, we get a safety score of a 90 with the dividend yield coming in at 2.92%. Scroll down with me, we will get a payout ratio coming in at only 59% with a 28-year dividend streak thus far. But more than that is to take a look at the dividend growth rate, which has all of my attention. That's averaging about 10% year over year over the last 20-year period. However, if you're really looking for an ultra safe dividend growth stock, yet one that also shells out quite a dividend, find that opportunity with Medtronic, ticker symbol MDT, which is a medical technology company that is solely driven without any other segments underneath its belt. That really just means that when there's economic pains and cycles, Medtronic really is under the gun here and feels all of those pains. But think about the medical advancements like pacemakers, blood analyzers, lasers right down to stents that keep the human heart beating, all stemming from Medtronic. Well, at least Medtronic or some of the other big players out there. But really, Medtronic leads the game, and I'm only certain that once the economic turnaround really does hit us, interest rates do come down, inflation is down, we will see Medtronic in the green again. So you're going to see as we click into the stock chart that right now it's trading for $80 per share after interest rates are drastically cut in 2025. Hopefully, I think again, more greenery, meaning Medtronic will have a challenge to face in terms of sales until then. But clicking to that 5-year view, you will see that because the economic environment hasn't changed much, here's just where we are today. We need that economic change. Yet scroll down, we will see plenty of revenue, projecting the health of the company overall with $90 billion in assets to just $39 billion in liabilities. But now have a look into the dividend metrics. We're going to see a company with a 99 safety score, which is top notch, along with a very desirable 3.49% dividend yield. Now, as we scroll down the page, we're going to discover that it has a payout ratio of 53% after 46 years worth of a strong dividend streak. And get this, a 12% average annual growth rate for that dividend, which is just out of a world for a stock like this. Reliability and deliverability. Now, investors, 3 down, 3 more to go. But before I cover them, here I am asking all of you again to help me out to get this number of 55% of you who keep watching my videos but not yet subscribed down to 50%. Commit. Join the journey, subscribe now, get that number down to 50% for me. And while you're at it, I want to know that you're finding value in this content. So tap on that thumbs up button to let me know to keep producing videos like this. Now, with that said, we're going to get back to it with one of the Mag 7 picks. We have Microsoft, ticker symbol MSFT, which really doesn't need any sort of introduction whatsoever. So I'm just going to get right to the point here and sharing that Microsoft is a perfect fit for investors seeking growth, yet also looking for a sliver of a dividend to enjoy over time as well. As we continue to advance into an AI future, Microsoft will certainly continue to be a dominant industry leader, and after it's experienced some recent hiccups over the last few months, it is not only going to gain momentum back, but poised to really continue a solid growth track, currently trading for just $440 per share. And if we click out to that 5-year chart, what you're going to see here is a better sense of the powerhouse that you could be dealing with if you're invested into it, almost 180% worth of share price appreciation. Now, scrolling down, we will find that Microsoft is, of course, delivering through on plenty of revenue year in and year out. Now, in terms of the balance sheet, which is incredibly important, we again see just a clean balance sheet to which Microsoft has us covered with 24% worth of an increase there in assets, topping over $512 billion with just $243 billion in liabilities. Now, if we jump right over to Simply Safe Dividends, we will see that Microsoft is a safe bet while capitalizing on growth with a 99 safety score, along with a nice 0.75% dividend yield, coming down to that payout ratio, nice and low, checking out at 25% after 18 years worth of a dividend streak. And have a look here now at the growth rate, averaging about 16% year over year for the last 20 years. However, if you are in fact looking for some more income, I would say that with interest rate talks that are all of our focus once again to look to REITs. Yet stay focused on the future with technology and add American Tower to your watch list. That's ticker symbol AMT. Now, American Tower is in fact one of Bill Gates' top picks as an owner, developer, and operator of wireless and broadcast communication infrastructure, as well as data centers on a global scale. It's on the Forbes Fortune 500 list with over 224,000 communication sites, including 42,000 plus in the United States alone. And I will say this now, this is just technological infrastructure that we need to continue to technologically advance. So for me, it's almost a no-brainer to look here. So when I see the stock is falling right now to a share price of $181, that's down by roughly 17% on the year, I cannot help but share it with you today. Now, the economic environment with interest rates that are impacting REITs, of course, over the last 5 years as well, American Tower is no exception here and has been hit pretty hard, still down by roughly 20%, even on that 5-year timeline. Yet scroll down, because we're going to see where this all matters most, generates plenty of revenue, and moreover maintains a clean balance sheet, coming in with over $66 billion worth of assets to just $55 billion in liabilities. As for the dividend yield, it will be a larger player here for you, but you're going to sacrifice maybe on some safety. Nonetheless, a 78 safety score, yet with the yield coming in at 3.57%. We're going to discover a 62% payout ratio, along with a nice 11-year track record thus far, while the dividend yield has been averaging growth by about 19% over the last 10 years. Now, if you really want the stock that I'm hyper focused on, literally I've been buying left left and right over the past 2 weeks, look no further than the one and only United Health. That's ticker symbol UNH. Now, for all of you who perhaps heard my 2 cents on United Health in my previous video or videos, I'm sorry, but I'm going to go ahead and share some more on United Health now because I want this to be an I told you so moment later on. Either way, there were a couple of things that really made me want to buy into United Health as a dividend growth stock investor. First off, Biden had pinned United Health down with a lot of antitrust cases, which actually had the stock fall. But after Trump's victory, we saw a rapid recovery, very strong recovery, and then the news came out that United Healthcare CEO Brian Thompson had been gunned down in Manhattan, and the stock fell to some really low lows. Now, all eyes have just been on really patient denial rates, and I'm going to say this. Is reform needed in the healthcare industry? Yes. Is it going to happen? Probably in some sort of way, but were we going to see drastic changes in the industry overall? I'm really doubtful. I think that Trump is actually going to give a huge boost of power into United Health and its industry peers. Current events are, well, current events and not future events, meaning that all of the noise will die down over time, and I think we just have an opportunity on our hands to buy now. Catch my latest portfolio update to actually see exactly what I've been doing when it comes to United Health, but right now it's almost down 9% on the year, trading for $491 per share from over $600 not too long ago. Click to that 5-year chart. We see United Health soared by over 67%. Of course, plenty of revenue with net income up overall by 11+%. And scrolling down further, an exceptionally clean balance sheet here with $273 billion of assets to $174 billion in liabilities. Jumping over to Simply Safe Dividends, a 99 safety score, a 1.71% dividend yield, and a very low payout ratio here, just 29% after 31 years worth of a dividend streak. And check this out, a 41% dividend growth rate, at least average. Now, investors, there's all 6 dividend stock opportunities. Let me know what you think of these 6 dividend stocks, what you're loading up on as of recently, or if you're selling out of stocks as well. I want to know, so comment down below. Tune in right here to learn how one man actually lost $1 million, or just about $1 million, to make it all back through dividend investing. You'll want to check that video out. Now, investors, until the next video, be sure you're subscribed, but I'll catch you in the next one.